Hi, this is Mike Larson from Money and Markets TV. The United States officially emerged from a grueling 18-month recession 2 years ago. But many Americans are still waiting to feel the effects of the so-called recovery. Well, they may have to wait a whole lot longer, because over the past week, we've gotten even more evidence that yet another recession may be looming. Personal spending went nowhere in May, its worst reading in 10 months. And adjusted for inflation, spending actually declined for the second month in a row. Meanwhile, manufacturing is grinding to a halt. The Dallas Fed's most recent reading fell further into negative territory, to its lowest level in nearly a year. And we're seeing a similar story play out in the New York and Philadelphia regions. Put them all together, and the decline in manufacturing over the past couple of months is one of the worst slumps on record. Meanwhile, the housing market keeps sinking like a stone. New home sales fell another 2.1% in May, while existing home sales dropped 3.8%. And the S&P Case-Shiller Index, which measures home prices, dropped 4% from a year ago in April. That was the biggest annual drop in 17 months, and it leaves prices at their lowest level since 2003. Finally, consumer confidence is tanking. The Conference Board's index missed economists' forecasts in June and slid to the worst reading in 7 months. But for anyone paying attention, this dismal data really shouldn't be a surprise. Despite politicians' insistence that brighter times were just around the corner, the fact is we didn't lay the groundwork for a healthy recovery. We didn't allow the free market to punish the irresponsible lending and debt accumulation that went on during the housing bubble. Instead, we tried to bail out everybody to make things less painful. But the result is that now we're still too buried in debt to fund a healthy, long-lasting rebound. And the amazing thing is that policymakers at the Federal Reserve and the Treasury still don't seem to understand it. In his most recent press conference, Ben Bernanke admitted, quote, "We don't have a precise read on why this slower pace of growth is persisting. Some of the headwinds that have been concerning us, like the weakness in the financial sector, problems in the housing sector, balance sheet and deleveraging issues, may be stronger and more persistent than we thought," end quote. In other words, folks, don't count on the Fed to get things right. They failed to stop the dot-com bubble, and they failed to stop the housing bubble from bursting, and now their plan to underwrite an economic recovery is deeply misguided. The bottom line is, if you want to ride out the next wave of this economic downturn, stop listening to the happy talk coming out of Washington and take immediate steps to protect your wealth. One of my favorite vehicles to help you do that is inverse ETFs, or exchange-traded funds that rise in value as sectors of the stock market fall. 2 weeks ago, I told you about an inverse ETF for the real estate sector that I think could take off in the next few months. You could also consider the ProShares ultra-short MSCI Europe, ticker symbol EPV, to hedge yourself against the risk of a meltdown in the PIGS nations. But especially with leverage ETFs, timing is key, and you have to control your risk with tools like profit targets and stop losses. I'm helping subscribers in my new service, Safe Money's Crisis Trader, do just that. For Money and Markets TV, I'm Mike Larson. Thanks for watching.